Think investing is only for the wealthy? Think again. Today, we'll show you how to start investing with little money, so you can begin building wealth no matter your budget. Let's jump in. Starting to invest, even with a small amount, can set you on the path to financial growth and stability. The good news is that in today's financial world, you don't need a massive sum to get started. With the right strategies and tools, you can begin building wealth, even with limited funds. Here's a comprehensive guide on how to start investing with little money. 1. Understand your financial goals and set a budget. Before you start investing, clarify your financial goals. Are you looking to grow a retirement fund, save for a big purchase, or build an emergency fund? Having clear goals will help you choose the right investment strategy. Once you know your goals, set a realistic budget, assessing how much you can comfortably invest each month. Even $25 to $50 monthly can grow significantly over time. This budgeting step is key. Starting with a sustainable amount builds the habit of consistent investing without putting pressure on your finances. 2. Start with a high-yield savings account. If you're new to investing and have a limited amount of money, consider a high-yield savings account as your first step. While it won't yield substantial returns like stocks or bonds, it's a safe place to grow your initial funds. High-yield savings accounts offer better interest rates than traditional savings accounts, often around 1 to 2% annually. These accounts can be a stepping stone for those who are just beginning their financial journey. Once you accumulate a few $100s, you can start branching into higher-yielding investments. Many online banks offer high-yield accounts without a minimum balance requirement. 3. Explore micro-investing apps. Micro-investing apps like Acorns, Stash, and Robinhood are designed for those who want to start investing with little money. These platforms let you begin with just a few dollars and often offer round-up features, which invest spare change from your daily purchases. For example, if you buy a coffee for $2.50, the app rounds up to $3 and invests the extra $0.50. Over time, these small amounts accumulate, helping you invest without impacting your daily finances. Micro-investing apps also allow you to invest in diversified portfolios, which are professionally managed for you. 4. Look into fractional shares. Buying full shares of high-cost stocks, like Amazon or Tesla, may be out of reach with limited funds. However, fractional shares allow you to invest in these companies with as little as $1. Platforms like Robinhood, Fidelity, and Charles Schwab offer fractional investing, letting you own a piece of a company's stock without buying a full share. This strategy provides access to larger companies with strong track records and the potential for long-term growth. Fractional investing is a powerful tool to diversify your portfolio, as you can spread your investment across multiple companies. 5. Consider exchange-traded funds, ETFs. ETFs are collections of stocks or bonds grouped into a single fund, allowing investors to diversify without picking individual stocks. ETFs generally have lower costs and are available in various categories, from technology and healthcare to dividend-focused funds. Since many ETFs don't have high minimum investment requirements, they're accessible even with a small amount of money. A broad market ETF, such as an S&P 500 index fund, can be a good starting point for beginners, providing exposure to top-performing U.S. companies. Most brokerage accounts allow you to buy ETFs for free or for a small commission, so they're a budget-friendly way to invest. 6. Invest in mutual funds with low minimums. While some mutual funds require thousands to get started, others have low or no minimum investment requirements, making them accessible for beginners. Mutual funds pool money from many investors to buy a diversified portfolio of assets, managed by professionals. Some funds cater specifically to small investors, such as no-load funds, which have lower fees. Look for funds for reputable companies, such as Vanguard or Fidelity, known for their low-cost index mutual funds. With even a small amount, these funds provide diversified exposure, making them a safe entry point into the world of investing. 7. Explore robo-advisors. Robo-advisors are automated investment platforms that build and manage a portfolio for you based on your risk tolerance, financial goals, and timeline. They typically have low fees, making them ideal for investors with limited capital. Popular robo-advisors like Betterment, Wealthfront, and SoFi Invest offer diversified portfolios with initial investment as low as $1. Robo-advisors invest your money in a combination of stocks and bonds, optimizing the portfolio as the market changes. For those who want a hands-off approach, robo-advisors provide a simple way to get started with a balanced, professionally managed portfolio. 8. Build an emergency fund alongside investments. While it may not be directly related to investing, having an emergency fund is essential. This fund will serve as a cushion, protecting your investments from being liquidated in case of unexpected expenses. Starting with small, consistent contributions to both an emergency fund and your investment accounts helps establish financial stability. Financial advisors typically recommend setting aside 3 to 6 months' worth of living expenses in an easily accessible account, like a high-yield savings account. Once your emergency fund is in place, you can confidently invest more, knowing you have a backup in place. 9. Reinvest your earnings. If your investments start to generate returns, reinvesting those profits can significantly boost your wealth over time. For instance, dividends from stocks or ETFs can be reinvested to buy more shares, taking advantage of compound growth. Many brokerage accounts and robo-advisors offer automatic reinvestment options, so you don't have to remember to reinvest manually. By consistently reinvesting earnings, you benefit from compounding, where your profits generate additional returns. This approach helps your initial investment grow faster, maximizing your wealth potential over time. 10. Keep learning and stay informed. The financial markets can be complex, and as a new investor, it's beneficial to continue learning. There are plenty of resources, including books, online courses, and financial news sites, that offer valuable insights into different investment strategies. Familiarizing yourself with basic concepts like compound interest, diversification, and risk tolerance will improve your decision-making. Following market trends and learning from experienced investors can also help you spot opportunities and avoid common pitfalls. A commitment to learning will improve your confidence and make you a more informed, successful investor over the long term. Investing with limited funds may seem challenging, but the strategies outlined above make it entirely achievable. Start small, keep your investment choices simple, and focus on consistency. With time, patience, and continued learning, even small investments can grow into significant wealth. Remember, the key to successful investing is to start now, regardless of how much money you have, and let the power of compounding work in your favor. That's how you can start investing, even with a small amount. If these tips helped you feel ready to take the plunge, don't forget to subscribe and share your investment goals in the comments. Thanks for watching, and I'll see you in the next video.